Hello everyone, and welcome back to Dr. Tao's Quant Lab. In section 2.4, we used the weeks to measure the systematic fear of the entire market. But how do we measure the risk of an individual stock? If you buy Nvidia today, how far can it drop tomorrow before the math says it's stretched too far? Today, we open section 2.5, volatility and mean reversion. We're going to map the mathematical borders of price using Bollinger Bands. Look at the chart. Bollinger Bands are made of three lines. The center line is your gravitational core. The 20-day, here, the 20-day moving average of the closing price. Why 20 days? Because there are roughly 20 trading days in a month. It perfectly captures 1 month of institutional capital flow. The outer borders, the upper and lower bands, are strictly calculated using statistical standard deviation. The math looks at the variance of the closing prices over those 20 days, multiplies it by 2, and adds it to the top and bottom. In statistics, 2 standard deviations capture exactly 95.5% of normal data. By setting the bands here, we define everything inside the channels as meaningless noise. But when the price breaks outside the bands, it represents a statistically significant 5% anomaly. It proves massive institutional force has entered the market. The single greatest secret to volatility is that it breathes. Markets compress and markets expand. A bullish signal means that a band expansion. After a round of decline, the stock consolidates with low volume. During this time, the upper and lower bands of bull gradually contract, and the distance between them becomes smaller. As volume suddenly increases, the stock price begins to rise. The upper band accelerates upward while the lower band accelerates downward, forming a clear opening expansion. For execution rule is that a volume-backed breakout above the middle band during an expansion is a premier bullish buy signal. Let's look at one example. Look at this daily chart of Tesla. From June 2025 to September, the stock stops moving. The daily range shrinks, and the mathematical variance drops towards 0. You see this? This forces the band to violently contract, pinching the price into a tiny corridor. This is a volatility squeeze. The law of quantitative finance states that low volatility always leads to high volatility. The squeeze is a coiled spring. Look at September 5th. Institutional volume hits the top. The price breaks the middle band. Okay, the price means the closing price, break this middle band. And the outer bands blow open opposite directions like a trumped. You see this? Like a trumped like this. It means that the standard deviation increases. And hence, this is a bullish expansion signal, as what we claimed before. And what is a bearish signal? After a massive upward trend, the distance between the upper and lower bands becomes extremely wide. If the stock begins to stall or fall at this high level, the upper band sharply turns downward, while the lower band continues to expand upward, forming a contraction pattern. This signals a clear weakening of a macro trend. And the execution rule is that a volume-backed breakdown below the middle band during a contraction is a strict sell signal. And let's look at the second example. Okay, it is also a daily K-line of Tesla. So if we look at this, after a massive upward rally, the band gets incredibly wide. But look closely at the top of this Tesla chart. The stock stalls, and the upper band sharply turns and points downward while the lower band is still rising. Okay, it basically means the volatility decreases. And this is a bearish contraction. It proves the upward momentum is mathematically dying. When you see this contraction and the red volume candle breaks below the middle line, like this, the closing price below the middle line, and that is your definitive sell signal to exit the market. And we also need this volume higher than the previous day or higher than the 5-day average. Okay, so this is a signal to sell the stock. Let's get back to the lecture notes. And as always, I copy paste these two examples in the lecture notes for your reference. For the third situation, for the sideways consolidation, during sideways consolidation, the distance between the upper and lower bands becomes small, and the bands remain nearly flat as trading volume shrinks. This can occur after either an upward or downward trend. You must wait for a future band expansion and a volume breakout above the middle band to buy. Okay, and a warning is that avoid buying too early during sideways consolidation after a decline, as you may simply encounter a continuation of a downtrend. Okay. As quantitative traders, we never use BOLL, B-O-L-L, in isolation. We integrate it with the tools we already mastered MACD and DMI. So Bollinger Bands gives us the boundary, but the MACD gives us the timing. If you see a bull expansion happening at the exact same time as the MACD prints a golden cross, that is a premier, high probability execution window. And we use the DMI, specifically the ADX line, as our regime filter. If the ADX is below 20, the market is flat. In that environment, the bands act as rubber bands, and we trade mean reversion, fading the extremes. But if the ADX is pushing above 25, a strong trend is active. We don't fade the band. We trade the massive expansion breakouts. And during our afternoon golden window, we use Bollinger Bands to check the state of the market channel. If you find the MACD golden cross, but the bands are currently erratic or contracting after a big run, the market is digesting, you rattle the trade. We only pull the trigger when the bands have been squeezed tight. and we get that massive volume breakout over the middle band to start a brand new expansion cycle. That's all for this lecture. See you in the quant lab.